Welcome back to Sean's Investing Adventure, where today I'll be taking you through my Sharsies portfolio at day 4. It's currently the 24th of January 2001, so without further ado, let's just jump straight into it. Okay, so right off the bat, you can see I have $1,274.29. As I take you through the breakdown of this in terms of shares, I'm just going to give a brief summary on why I decided to buy these particular shares. And basically my shares are split into sort of three categories. There's ETFs, there's shares that I'd like to hold for a long period of time, and there's shares that I have sort of less than $20 in that I just bought on a whim. So we'll start with 3M. 3M is the first of the shares that I bought on a whim. I basically selected this share because of their market reputation, I guess. So the story behind this one is for my day job, I was in a trade store, electrical suppliers, and I was just picking up some electrical tape. And I grabbed a random packet off of the shelf, and the store clerk basically said I should choose a 3M product because for the same price point it's a much superior product. So based entirely on that anecdotal scenario, I decided to buy $10, almost $11 of shares in 3M. The next share on my portfolio list is Air New Zealand. So I bought Air New Zealand early September. I selected Air New Zealand because New Zealand only has one real airline, and it's pretty heavily government funded, so it's kind of impossible for it to fail. It's one of these companies where the government will just keep throwing money at it and ensure it succeeds. So I bought it while it was quite low, and I'm just dollar cost averaging while it climbs back up to its previous heights of about $2.50 per share. Alright, the next one is Apple. Apple's a fairly recent acquisition of mine. I don't know why I didn't invest in this earlier, but it's one of these shares that I plan on holding for quite a while, and I will continue dollar cost averaging into this product. Arvida Group. This is one that I purchased, fairly early on, late September. I bought this because it pays regular dividends. I think it pays 4 times per year, and my sort of end goal is to gain dividends. I don't know why, I like to see numbers coming in. I don't get the same endorphin response from just looking at my portfolio increase in value. I like to see that come back as an actual dollar figure. The next one is an incredibly recent acquisition, is Barramundi. I've only purchased this, a few days ago? So yeah, less than a week ago. This is another one I purchased because it has a high dividend yield. Coca-Cola is just a staple. Everyone likes Coke apparently. So I bought a few dollars worth of shares. Was that 0.12 of a share in Coke? Genesis Energy is one of the energy companies in New Zealand that I didn't have any shares in, so I just bought sort of $10, $8. I think I've put into this. Yeah, $9.21. So less than $10 I'll put into this, and I'm just going to hold it probably at its current value. This does have quite a high dividend yield though. Maybe I'll buy more into that. incredibly high price to earnings ratio. I have to look into this one in more depth later. Johnson & Johnson's another one I plan on building the sort of value of, but I've bought shinier, newer stocks instead of this staple. I might return and rectify this. Lockheed Martin's one I bought on a whim, and it's been doing not so great, minus 12%, constantly going down. So I think I'll just hold on to this where it is and sort of let it either fizzle out or rise back, and probably sell it off when I break even. MasterCard, I think I purchased both MasterCard and Visa, just a few dollars in each. No real reason why, other than I think my FPOS card has a Visa option, or is a Visa card per se, so I just bought both of them. McDonald's, who doesn't like McDonald's? I believe they pay a pretty healthy dividend. There we go, 2.3% dividend yield. I sort of just plan on holding this for forever, and buying more into McDonald's. 2.3% is not actually healthy. Oh well. Next two is energy stocks in New Zealand. Both Mercury and Meridian, both of them have gone up by upwards of 25% since I purchased them. I purchased these because they have quite high renewables ratios in their production. I believe one of them is 100% and the other one is close to 100% renewable energy. And with New Zealand going to a big shift towards renewables, I thought both of these were solid companies to buy into. As you can see, both Mercury and Meridian have been doing fairly well, pretty well since I purchased them. New Zealand Wind Farms is a very, very low cost sort of penny stock, if you will. I've been purchasing them since basically I opened this Sharsies account, and they've had a return of 30%. They have a very, very high dividend yield at 9.3%. It's irregular, so they only pay it when they feel like it, but the company is looking to put forward a regular dividend policy. So I will keep buying into this company until they release that policy, and then I will reassess it from there. PepsiCo, I bought Coca-Cola, gotta have Pepsi. Realty Income Corp, these guys pay dividends monthly, and I was looking at getting enough shares that it pays so I could get the $1.50 worth of dividends each month to basically pay for my Sharsies account fees. So I'm slowly acquiring more of this company. As you can see, I've received 23 cents of dividends, so it's not quite there yet, but one day. So I think from here I will just go through the three ETFs that are here. We have the Australian Smart Shares, the Smart Shares New Zealand Top 50, the Australian Smart Shares Financial Fund, the New Zealand Top 50, and the Vanguard S&P 500. All of these sort of diversify me in countries. The New Zealand Top 50 is the cheapest by far at $3.50 a share. Again, it has a nice little dividend, and a pretty low management fee, so I'll continue buying into this into the future. Again, the Smart Shares Australian Financials Fund, slightly more expensive, slightly higher management fees and a high dividend yield, and it's also grown a lot more as the Australian market recovers from the coronavirus. And then the Vanguard is by far the most expensive, the Vanguard S&P 500, but it's also had quite a consistent sort of uptick, and I'll continue buying into this pretty much indefinitely. There is no management fees for this one, and it also has a lower dividend yield, so that sort of balances it out with the New Zealand top 50. Still a little bit worse than the Australian, but that's fine. Alright, then we have Tesla. This is another really recent purchasing. It's gone up quite a bit since I purchased it. Who doesn't like electric vehicles? There's not much I can really say to this other than jumping on the bandwagon. Texas Instruments. I used to have the old TI-84 calculator, so why not buy Texas Instruments? That's pretty much the amount of thought I've put into this, but it's turned out to be a pretty good stock to hold. And then Visa, there you go, there's my less than $6 of Visa. It's been pretty flat while I've been owning it. Pretty low dividend yield and 5-year growth, I suppose. 175% is pretty good. Obviously, I'm down 8 cents from what I've put in, 1.39%, but that's fine. I'll hold on to that for a little while and see what it does. And then finally, I have the Vital Healthcare Property Trust. This is another one that I will be purchasing more of. It has a nice little dividend yield that pays 4 times a year. Sort of doesn't have a slow market uptick, it sort of jumps in sporadic little bursts. But I'll hold this and see how it goes in the future. So as you can see, I basically don't put any thought, or very little thought, into the shares that I buy. I plan on doing more company analysis in the future when I have time, when I'm not sitting down playing video games. Yeah, that's the introduction to my Sharsies portfolio.